You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
Welcome back to the option block, everyone's favorite. I know it's my favorite. Hopefully it's your favorite as well, bi-weekly source for all things options related. My name is Mark Longo, and usually this is the part of the show where I tell you I'm coming at you from the Options Insider Studios here in the options capital of the world. And that still is, I suppose, technically true, but we're changing things around a little bit over here in the old Options Insider HQ this week. So if I sound a little bit different, I'm actually beaming in from the office portion of the studio. So who knows, you may hear some little typing in the background. We're also across a beautiful view of downtown Chicago, but that means we have windows and all sorts of ambient noise coming in, including from a huge construction site across the street. So you may hear all sorts of fun ambient noise. This is why I usually record in the nice sound mitigated studios. But we'll do what we can. We will muddle through. Speaking of muddling through, even Uncle Mike taking it on the chin, taking a bit of an assignment today, a little bit under the weather, so he's out. So instead, I am joined by my usual partner in crime, my cohort in all things options, the rock lobster himself, Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the program, and now you have to do double duty filling in for Uncle Mike as well, so have fun, sir.
I just want it noted for the record that who is the co-host that shows up the mostest? That's all I'm going to say. I'm just going to leave it right there, and I can let Tussaw and the Meatball take umbrage at a later date.
You do your fair duty on showing up, sir. I can certainly give you that. You get the attendance award.
Well, let's get something.
You're the kid who shows up at the end of the year, and you get the 100 days attendance award.
Exactly. The kid gets nothing else but 100 days.
What every kid dreams for as they're growing up here. All right, and with the scene set, listeners, we're going to dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, everybody, welcome to the Trading Block. You guys know the drill. This is indeed the portion of the program where we break down what's rocking and rolling, what's moving and shaking on the old street today. And even in my limited setup here, we can still do a deep dive into all things options related on the old street. And it was a bit of a turnaround, you might say, towards the latter half of the day today. We were watching, it's one of these days where, if you, depending on when you checked in is what narrative you saw unfolding on the street. By the way, we are recording this on Monday, January 25th, for all of you out there playing along with the home game, and it was another one of those interesting turnaround days. We had an intraday high. It seemed like things were going to be, if not hunky-dory, at least decent on most of the street today, with a lot of names doing all right, some selling off. Obviously, oil starting concerns over that, starting to drag things lower as the day progressed. And then we saw continued, shall we say, unease over China piling in. We also got the Fed looming on the horizon, and that certainly doesn't make anyone really get a warm fuzzy down deep in their hearts these days. So I think the combination of all of that, and there we go, listeners, once again, I apologize. We are, like I said, in the office portion of the studio, so I can't even mute all the lines coming in here. So we had an intraday high out there in the S&Ps of about 1906. That's, of course, where we opened. So that should kind of tell you where essentially the narrative, it was down, but it wasn't as aggressively down as we closed on the day, right around 1876 or so. So off about 29, actually 30 handles. So about over 1.5% as the day progressed. So the sell-off exacerbating to the downside. A lot of good news coming out of the market today, but even that couldn't stem the red tide from growing on the street today. Mr. Rock Lobster, a lot to parse. Where shall we begin? What caught your eye in today's activity, sir?
Can you tell me why everything's connected to oil again?
Yeah, right? When oil's over 100, 140, it's the worst thing on the planet. It wipes everything out. No one has any money left over in their paycheck between buying gas and buying groceries and buying airplane tickets, and everything's destroyed. And now below 30, it's the worst thing on the planet. It's going to destroy everyone again. Because we all know everyone's got oil stocks in their 401k.
Well, last week we joked about the source of the volatility, and I swear it is just... I am befuddled. I'm not befuddled like, hey, stocks go down, stocks move around, vol goes up. I got that. But, somehow the narrative has changed, and I just don't think everybody got the playbook. So, I'm looking at almost every vol pullback as a buying opportunity, it feels like, for volatility. It's just, there's not a 1% move now. It was funny. I was just joking in our chat room. It's like, the SPY was down 3.5 handles, and everybody's like, big whoop. Like it doesn't matter. And I know it matters, but we're just dealing with a market really that does not know it cannot find its way. It's trying to decide whether the growth since 2009 basically in the equity market is over or not. 2100 looks a long way away. I am even going to go out on a limb, and they say we see that number in 6 months, maybe longer, until there's a reason for equities to rally. So in order for that to happen, you need some sort of something to kind of go right, or something just to stop going bad. I guess oil going down is bad because it's supposedly destabilizing credit markets. And until that happens, I guess we're going to stay volatile. So, if you see oil looking weak in the day, just go sell equities, because by the end of the day, it looks like they're going to be lower. It seems like it's money every time.
Yeah, it kind of blows out of the water all those correlation theories from efficient capital portfolio theory from the 90s and 2000s, where you have 60, 30, and 10, and maybe that 10 is the non-correlated asset, oil or whatever. And certainly ain't playing that tune these days. If oil was your hedge, your diversification, you're riding that train down along with your stocks right now, and that's not exactly what you want in your hedging vehicle. Hence why we tend to like options here, because at the end of the day, you think about it, Mr. Rock Lobster, the only thing that really provides you that true inverse correlation that you want is your freaking put option. Everything else is crap.
We just did a portfolio management class, in the option pit, our Saturday class. We have one Saturday class a month, and everybody's asking me, what's your non-correlated asset? I go, volatility. I can pretty much guarantee you when the SPY goes down, VIX options, certain vol product options, puts in the SPX, they're going up. They're going to keep going up until the market stops going down. So, that's where you hedge. That's where the stuff is. Buying a stock here or a stock there, one will outperform the other, obviously. And, stocks like Facebook and Google have held up really well. Microsoft has held up well, because I don't think that story changes too much there, but they're all down 10% from their highs. So it's not like they're unscathed, but buying puts and rolling them and using some risk management techniques like Mr. Tusaw uses, it ultimately, that's what you want to look for. So the easiest way to do that is just to learn something about them, or have Tusaw buy some puts for you. One of the two. Take your pick.
There you go. Have someone do something for you. Do something. That gets back to your narrative from your first episode on this show, right? Do something. Go out there and do something, and hopefully get your juice for free. But you're right. You sound kind of like you've been reading some of the SIBO literature out there of volatility as an asset class for non-correlated stuff. I think even beyond that, 'cause I do concur. Volatility is mostly non-correlated. It has that bit of a fudge factor, 20, 30%, call it what you will, depending on the day. And some days completely the same because of all the tradable, and particularly if you're looking at pure VIX, that's obviously its own beast. But that nice straight up put, at the end of the day, you got the vol premium and you got that nice delta working for you. It's kind of hard to overcome both of those. Right? When you got both of those in your back pocket, things tend to look good. Of course, speaking of looking good, the rest of the street really wasn't looking too good today. We, of course, oil taking on the chin, so big names like Hess and others off over 6% today. Of course, as Andrew alluded to, all this oil talk starting to spill over into the banking sector as well. Talk about these banks being perhaps over-levered to the energy sector, and so those names taking it on the chin a bit today as well. Bank of America off over 3% during the day today as well. And despite of that fact, and of course NASDAQ off over 0.5%, actually on the end of the day, over leading the charts of the downside, about 1.5% there on the NASDAQ, kind of going back and forth with the S&P for who was the laggard of the day, but they're both looking pretty weak. Of course, crude, WTI taking out the chin off over 5% again today, over down around that vacillating back and forth, that will they, won't they 30 handle. And again, that kind of dragged everything down. Equities, if they stay on this track through the end of the month, we got about a week or so left. It's going to be their worst January. I don't think it's really a surprise since 2009. And we know 2009 January was a bit of a tumultuous time, to say the least. So the fact that we're even vying with those days is a bit impressive for, I guess, depends on your viewpoint, or terrifying, depending on how you look. And of course, Tusaw is in here. I was going to put this to him, but of course, last week, he's kind of our resident technician in the fact that he looks at a chart at least once or twice a week. And the last week, of course, S&P hitting that oversold level, a technical oversold. So that could have been perhaps fueling some of the near-term bounce we saw. Of course, short-lived as it may have been, off about 7%. So far, a little over 7%, and not factoring in today's aggressive sell-off so far today, and about over 11% since May, the height back in May. So aggressive stuff. But that said, Mr. Rock Lobster, there was some good news on the screen, starting with my favorite story of the day, and one of the few greens on the old screen today. Good old Mickey D's coming out, blowing the doors off of it. And do you know why they lit it up today, Mr. Rock Lobster, on the day when everything else was selling off? They were up nearly a full handle, or nearly 1% on the day. You know why everyone was loving Mickey D's today and last quarter?
I have to tell me.
I will say, it's just the one thing I've been beating the drum for about a decade now. All-day breakfast. Finally did it. All-day breakfast. First quarter reflected in the results. And guess what? They're stellar. They blew the doors off of it. Because guess what? Everyone wants a freaking Egg McMuffin 24/7. And, I could certainly speak for that cadre of people who'd rather have an Egg McMuffin and perhaps a hash brown than just about anything else McDonald's has on their menu. So after decades of people beating that drum, they finally acquiesce, Mr. Rock Lobster. And look what happens. They blow the doors off it. Even on a day like today, who knows how much they would have been up if the beta hadn't dragged them down, that pesky beta.
Well, the easiest thing about breakfast all day is they don't even have to do anything. They just sell more stuff. Oh, we've got to order more hash browns. We have to order more Egg McMuffins. We have to order more sausage biscuits. I mean, come on. That was like... They can't sell enough of it now.
Yeah, apparently that's the case. I mean, they're just lighting it up over there. So yeah, everyone go figure. Everyone and their mother telling you they want it, and it translates into sales. So there they go. After many years of them exploring the issue, and I don't know, I think they had some issues. I think with transitioning the kitchen from breakfast to lunch, or whatever excuse they kept giving to not do it. They finally went around and did it, and it seems to have bolstered them. So even on a day like today, the Mickey D's lighting it up. And of course, again, I was going to toss this one to Uncle Mike. I don't know if you noticed, Mr. Rock Lobster, but he's starting, it sounds like, with Apple kind of slumping back down to the dark side a bit, that south of the 100 handle. He was starting to waver a little bit in that, no more washing my hands of Apple until they have this great new innovation. Last show, he was kind of like, when they're in that mid 90 range or so, he was starting to say, I don't know, they're looking a little bit more. He sounds like an old junkie. You know, he can't stop himself from dipping back into that well. So at least as far as I know, I haven't talked to him today. He hasn't jumped back in, and I'm guessing today probably was not the day that would lure him back, because it was indeed a bit of an upside day. Apple back, at least flirting intraday with that 100 handle before closing back to the south of it. They're at about 99.5 or so. And of course, the big news out of Apple, of course, is that they are coming up on the big fruit company earnings day. They are announcing tomorrow. So we will have one extra day for you guys to sink your teeth into Apple. But of course, we won't have a show. So we'll dive into it now. And of course, the name hovering right around about $100. We're seeing that weekly par straddle going out for around 6.30, 6.5 or so. So around 6.5% or so on the day here for that straddle. And surprisingly, I mean, they still have tomorrow to go, obviously, too. But surprisingly, given the sell-off today and the fact that earnings are looming tomorrow, not the heaviest of volume days. They've been averaging about 700,000 out there in Apple land of late. Today only doing about 550 or so. So not even breaking the ADV today, which is either interesting or also could also say that, you know, they've just been rocking and rolling so much lately that everyone's kind of playing the wait and see game. We are seeing a little bit call heavy, about 1.6 to 1 calls over puts out there. But I think we're a long way, Mr. Rock Lobster, from the heady days of you could buy verticals in Apple for almost a credit. Oh, those heady days. Those are beautiful. But I'm sure Apple was lighting it up in the pit chat today. What was going on over there? And what...
You know, we were trying to price that. There was an interesting trade where somebody sold an at-the-money call and bought a Feb upside call, which it looked pretty bearish. So mostly I think the consensus in the pit chat has been, you know, the expectations are so bad in there that they probably can't be as bad as the expectations actually are. So, you know, because the stock's trading close to its lows it's definitely very close to its lows of the year. It was trading 95 or something like that when we had that mini flash crash in August. Traded really close to that level again, you know, a couple of weeks ago. Just really awful. So, you know, I think Tussauds right. Without a growth story, it's just going to keep getting a lower and lower multiple as you know, revenues, they still climb, but they're not giving revenues any kind of multiple whatsoever over there. So they need a car, they need something. And then I guess there was something where the guy that was supposedly developing the iCar has left. You know, not a ton of great news as far as the growth front, because whatever top secret project they have is real top secret, because nobody thinks anything's going to happen there. So it's the world's biggest, most well-run utility.
Well, selling verticals going into Apple earnings, that was like a recipe to lose money just a few years ago. If you wanted money you never wanted to see again, selling verticals, upside call verticals in Apple was kind of, because even though the zealots bid up that crap like crazy, even on the at-the-money, it still pretty much outperformed or came close to it every time to the upside. So if you were selling verticals, and you wanted to have that short leg be the crazy garbage out of the money stuff, because they were just bidding that up to high heaven. I can't imagine a scenario back then where selling the at the money, buying the garbage worked out. But, you know, maybe once in a while it did. But yeah, now these days, you're right. Talk about how the worm has turned. Now you can sell verticals out there and it's not instantly putting a gun to your head. What do you think when we will see the day when all of a sudden there's a hefty put skew out in Apple?
It's weird, because you would think it would be kind of there at this point, but it really isn't, because the stock is trading at such a low multiple. It's, you know, where's the bottom for it? Like $80, $90, you know, $85 at that point. You know, after their cash, the business is not only worth $200 billion or something. So it's getting to be like the VIX at some point. You know, the VIX can't go below 10. There's got to be some intrinsic value to Apple. I don't know what it is, but I'm thinking like around $85. It's getting pretty cheap. So and Sebastian put out a piece about Apple being the Sony of the new generation. You know how everybody had to have their products, and they had the Walkman, and then all of a sudden, nothing. And Apple, and I think that's where the real fight is with that stock, where Apple, as far as creating the ecosystem to keep people in, they've done a really good job with that. But Sony they made hardware products. They didn't have near the depth of, it's like trying to change your iPhone now and move all your stuff that's in the cloud. I mean, there's a lot of inertia. It's like trying to change a bank account at this point. People really don't do that unless they have to. So as long as they can keep up with the technology or kind of promote stuff, it will keep people buying the phone, and then it's kind of more like a utility than a growth company. So, but I think that's where the valuation crunch comes in. No, without the growth, it's just a company that pays a good dividend, and the revenues grow a little bit every year. That's it.
Yeah, it's been a fascinating story to watch. I know Sebastian loves that Sony analogy. He's been beating that drum for some time. I don't know. I still like to hit my old Sony style stores if you can find one. I think there's one in Las Vegas. That's about it. There's not many of those left around anymore. You could go buy your ultra expensive Walkman. But c'est la vie. Those days are a wee bit behind us. But yeah, there is certainly that transition perhaps looming for them. I would be interesting to see that day, because you're right. You would think there may be a bit of a market bid to the puts right now, but we have not really seen that materialize. And you're right. I don't know if it is the breakup value. You see differing numbers bandied about for that. You see a lot of numbers bandied about for that breakup value, $7 a share, more or less. So it really depends on how they utilize their cash, but they also surprisingly have some debt floating around out there. That number isn't bandied about that often. So when you see how much debt they're sitting on, whatever it is, $250 billion, whatever the case may be, and then they see how much debt they're floating around, it actually is a bit smaller number when you take that debt out of the equation. So there are some interesting numbers to be bandied about there, but you're right. Things like the iPhone slowing a bit. I mean, the thing can't be the hottest thing on the planet forever, obviously. Obviously, China a bit slowing down. That's going to slow their growth over there. Big categories like them, like the iPad that came roaring out of the gate. Now, not so much. People don't buy a new tablet every year, even every 2 years. Heck, I'm still running with an old iPad 2 here for some of the backup systems we use here and stuff like that for some of the shows. So, yeah, you can use these things you can limp along with them for a long time. So they're kind of like PCs in that sense. So, yeah, the upgrade cycle, perhaps not the 2 years they were hoping for there on the iPad. And then, of course, the watch and all these other event things, the recent battery pack they came out with, all these things perhaps showing to the Apple zealots that this is not the design haven they used to be. But c'est la vie, we've been bashing on Apple for a long time, and they continue to rally in our face. So they don't really pay attention to us. But still interesting nonetheless. We'll pay attention to them certainly as the earnings roll in later this week, as I'm sure as a lot of you will do. But now it's time for us to keep on rolling with the show. Right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that funky tune means it's time once again for the Odd Block. You're probably one of your favorite segments. I know it's one of my favorites because we get to dive really deep into some obscure and interesting trades. So let's keep on rolling with the ETF category. Not XLE, Uncle Mike's favorite name to play in these days and blast out some puts, but it's related cousin XLY. This is the Consumer Discretionary, Spider ETF, closing today right around 72.5.
Just based on the closing prices, look like basically somebody hit the bid to get out of the call spread. And where XLY was a couple of days ago, it dipped down to $69. So I think somebody probably picked the call spread up for cheap, took some money and worked it into a 1x2 Feb 73.5, 77 call spread, buying one, selling two. And basically, they're looking at kind of the sky's the limit on the upside. I mean, realistically, 5 handles for this product is about 8%, which is a huge move. And it was like 7%. So it's doubtful you're going to get the move, but they got it once. It went from 68 at the lows last week to around almost $73. So a little over $73. So it does have the potential to move, and I think they just want to take some profits and move along. So we'll see what happens. But I mean, when you see the open interest is almost exactly 8,000 contracts, that's most likely a close. They got out on the opening when we didn't get a continuation of the rally, and then they rolled into something. So basically, they could pocket some dollars but still stay long. And I think we've seen that, I don't know, once or twice here on the old.
Once or twice, maybe thrice here on the old odd block. And listeners, if you're saying to yourself, that's all good, that's all well and good, but I need me some more crude talk, well, don't worry. We got you covered with our final name here. This is, again, in the energy sector. This time, Patterson-UTI Energy, Inc., ticker symbol PTEN. So PTEN out there, listeners. And these ones, they maintain land-based drilling rigs and a fleet of pressure pumping equipment. So here you go, more crude-related activity. This one closing, as you might expect, taking down the chin yet again, right around 11.5, off nearly 10% on the day, or over one handle on the day. This is the name that does, about 1,500 contracts, doing nearly 24,000 today. So a pretty aggressive amount here. And what we saw catching our eye out here, pretty much of that 24,000 or so, about 20,000 almost exactly, coming in this one, 20,002 actually coming in this one sizable, I suppose you can call it a collar here. It was out in the AUG expiration cycle, listeners, and what caught our eye was the AUG 1014 collar. If you remember where I said it was trading right around 11.5, so this one kind of splitting the difference. Right in the middle there, close to that 12 handle. And this one, of course, collar, buying puts, selling calls. They started doing it this morning, 5,000 times buying the put, selling the call, doing it for 19 cents. Looks like in this one, the put is over, so they were indeed paying. And as the day went on, they did another 5,000 for the tune of 10,001. On each side. Don't have the prices on the latter kind. I'm guessing they might have paid up more for the latter kind as the stock continued to sell off. Looking around for some prints again in the underlying to see if perhaps there was something afoot, some hedging, some other activity going on against this trade. Didn't see any of that either out there. So it looks like yet again this is what it appears to be on the surface. Someone who's sitting on a bunch of P10, perhaps a shareholder who perhaps does not really want or cannot part with it anytime soon, wants to collar themselves a little bit, and then if they are indeed a shareholder, I'd imagine that they probably do rally again. They wouldn't be too upset about it, A, and B, probably rolling that 14 handle out to something else in case they can't actually sell the stock. But still, nonetheless, they're dumping a call against it. So not reticent on one leg there to have that short outstanding. And talking about what Rock Lobster was talking about before, all these names just taking on the chin. This one back in May or so of last year was trading about 22.5. So this thing pretty much cut in half since its highs, at least 1 year highs back in May here. So our friend here saying that he wants to hold on to it, doesn't want to dump it just yet, but still, as I don't think you can really fault him, a little bit concerned. He's obviously got a sizable position on there out here in good old P10 and looking to hedge it and not really looking to pay a lot. Mr. Rock Lobster, take us home here with this pretty sizable collar in Patterson-UTI Energy, Inc.
I was trying to figure out if this was like a straight short on the Patterson. I don't know. You see the collars like this at such a long term, isn't it? Don't you feel like that's kind of a hard sort of short for a long term position? I mean, I guess it certainly could be. They're like, okay, they're looking at this as in Patterson go to like $4 or $5. Whoever knows how low these stocks can go. So many of them are trading single digits. I think at this point, somebody that's long will be happy to be stopped out at $14 and be happy about it. And that would be that would be almost like a 50%. Yeah, let's see, $3 and $2.5. So, 20% gain on the upside, and they'll take it. But they don't want the stock to go to zero. And I think you're seeing more of that where, you can buy a stock and you can, take, a small loss in it, but you don't want an $11.5 stock to go to $4 because then that's just disaster. So, and then you're stuck with that loss. So at least if they have a put they could sell or hold a put against the equity and decide what to do. So I think you're probably let's just call it the bottom fishing technique. You're going to see probably more puts with stock, because if you have a bounce, those upside bounces are going to be pretty good, because right now they're kind of marking the future of this business at zero, really. I mean, a lot of these companies are trading at book value or below. So there's a lot of blood in the water with these businesses at this point.
Yeah, I hear you with the longer term on the collar there. I'm looking, as you were talking, at what else is available out there. Probably some of it is just a dearth of selection of other months. They got May, and that's pretty much it until Aug, So maybe they wanted to go shorter, and it didn't really fit. I'm looking at the May. I'm pricing up the May. You're going to pay at least 15, 20 cents to put that one on out there in May. And at least with the early kind they got in the Aug, they got 19 cents for that initial kind. Of course, things sold off eventually, but still, they're going to figure they're going to pay a debit for it. Maybe they want to get a little bit farther out. But I hear what you're saying there about maybe doing it a little bit longer term, or not doing it as often longer term in the collars. You're right, that isn't the paper we always see. But I'm somewhat encouraged by that, rather than just, let's say, a Feb zero cost collar somewhere that they got to just roll again, in a month or two. Maybe they're willing to pay a little bit to actually get some actual protection on the thing. I know that flies in the face of your juice for free credo, but in general, I'm not too up in arms about it. Interesting stuff. Let us know what you think about all this interesting spec here we have going on in crude, listeners, whether it's our friend out there loading up on some levered upside in UCO, or our other friend here putting on a collar, worrying about continued downside in PTEN, or perhaps something else in between that caught your eye. Let us know. We love to hear from you guys. Speaking of hearing from you guys, Uncle Mike on assignment, under the weather, call it what you will. We're going to dive on into an extra special listener mail segment just for you guys.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to this extra special Monday edition of the Mail Block. And like the man said, this is the portion of the show where you guys get to reach out to us with your questions, your comments, your tweets. Find us at Options on Twitter, on Facebook, we're the Options Insider. Stock Twits, Options Insider, or just questions at theoptionsinsider.com. If you have that burning options question, burning a hole in your brain, send it over to us. Save yourself some brain holes. We all know how painful those can be. Or, of course, surf on over to the website, theoptionsinsider.com. Post a comment, use the website feedback form. However you want to reach out to us, or just grab the mobile apps all baked in there as well. No shortage of ways for you guys to hit us up, just like our first listener did. Sean, he writes, this one could have a bunch of possible meanings, Mr. Rock Lobster, so we'll break them down as we see them. He writes, what is the characteristic for trading options when the price nears even strike levels? And there's a lot of different ways you could perhaps interpret this question. Perhaps the first way you might think of is, well, like we were just talking, a dearth of month selection for P10. There's also opportunities where you have a dearth of strike selection around where you actually want to trade. Let's say your name is trading, 101.73, and all you have is the par and the 05 strike. Not a lot of selection there. So maybe he means when the underlying actually trades to an even strike nearby, drops down to the par strike, what are the considerations therein? Or perhaps he could also mean, what we see a lot working in underlying and in options as well. People just working orders around even strike levels, 100, 150, those kind of things. And people just like to do that rather than working their stock order at, 101.13 or something like that. And it's just not the way the human brain works. So either way, I think you take it either way. It's kind of they're kind of similar in the retrospect, in that there isn't really a heck of a lot of massive change. One of the nice things about it, if it is an even strike where there's a lot of orders being worked, is you can usually rely on that liquidity to help you get in and out a little bit better. The market should be a little bit tighter. Market makers, others should be more willing to step up and fill you mid-market if there are a lot of orders working in and around that strike. So that's in general a good thing. It can provide liquidity, which I think is a nice boon to anyone looking to reduce their slippage when they're getting in and out here. In terms of getting to even, numbers, 100, etc., it's a similar thing, I would think, in terms of just you want to be where some order flow is. That's nice. Aside from that, people harp on pin risk a lot, so I suppose I should bring this up because whenever you're hovering around strikes in and around equity options, that's the one quote-unquote risk that comes to mind. Again, it's overblown quite a bit for the most part. It sounds sexy, pin risk. It's not really an issue for most people, in these days of automatic assignment. And of course, if you're an automatic exercise, and of course, if you're following along what we preach on this show and you're closing out your shorts on or around expiration day anyway, then pin risk is not an issue for you. But if you are so inclined to let your dice fly high and let those puts stay open all the way through to the close, then perhaps pin risk, I suppose, could become an issue for you if you are trading to the dark side and there's a lot of open orders still on whatever even strike you're trading. That's about all I got for even strike. So A, how do you interpret this question, Mr. Rock Lobster? And then B, what do you have to say for our friend here, Mr. Sean?
Well, it took me a second. So even strikes meaning like, okay, let's say net fix at 100. We had a trader that was looking at, I think, when you're below an even strike, it seems like there's always some sort of gravity to it, like with the S&P 500, there's 1,800 and there's 1,900 and there's 2,000 and 21, those big even numbers, I think, tend to be gravitational, pulling. For whatever reason, they seem to be short-term self-fulfilling prophecies. So, and generally when you get to the strike, volatility compresses as you move into a strike. So setting up trades that benefit that way certainly could make some sense. So, those would be the first things that would come to mind when you're talking about even strikes or when the market's at kind of those inflections where people are interested in that.
Yeah, that's kind of how I saw it too. But there are a couple of possible interpretations here. So I suppose we will run with whatever your interpretation is, listeners. Hopefully we covered it for you. It's a bit of an open-ended question, but either way, that's all the time we have for our extra special quick Monday edition of the Mail Block. Don't worry, we'll have more to get to you guys with on Thursday. But now it's time for us to roll on into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. You know the drill by now. This is the portion of the show where we break down what's rocking and rolling, what's to come this week, this heady week in the market. And, macro stuff aside, this would have been a very interesting week in and of itself because this is the week where a lot of the names you guys like to watch and trade are popping off when it comes to earnings. We talked about Apple already at the top of the show. They are popping off tomorrow after the close, Tuesday the 26th. And then we got good old FB, Facebook, coming up on Wednesday. We're not going to have a show between now and then, so let's do a quick dive into them. They closed today. I think it was around, actually they sold off yet again. They were hovering at the 98 handle when we were compiling the notes, sold off again to the 97 handle. That straddle, it was around $7, $7 to $7.20 or so at the time, so a little over 7% that they were pricing in on Facebook. We'll see if that holds true going into Wednesday's session, but they're predicting a little bit of rocking and rolling out there in Facebook land, so an interesting one to watch. Of course, Thursday, a lot of the big rock and rolling names coming out. Amazon, EA, Ford Motor Company, not really a rock and rolling name, but who knows, with all the China news, that could be more of a heated issue this time around. Good old Softy and Alibaba, and of course the ever sexy Xerox coming in at the top of that list. And on Friday, we got the Googs coming off, or Alphabet, or whatever the heck they call themselves these days. So a lot of big names that you guys like to watch. And if that wasn't not enough, listeners, we also have good old Miss Yellen raising the ugly specter of rates yet again this week. They got a 2-day meeting kicking off tomorrow. I don't think anyone really puts any credence in raising this week or any time in the near future. We were just debating this on the Volatility Views. If you want to get in on that action, check out the episode that posted this morning of our most recent episode of Volatility Views, where we kind of do a nice over-under on the whole rates change market for 2016. Some interesting perspectives on there. I won't spoil it for you. Check it out for yourself if you want to hear it there, listeners. But a lot there. So that's gumming up the works, of course. Amidst all that I just said, and perhaps some things I didn't say, Mr. Rock, what are you paying attention to this week?
You know, oil companies aren't doing well. Technology companies seems to do okay. The banks seem to do okay, but oil earnings are so bad, it's going to drag everything down. I mean, they're all down 50, 60, 70% or worse. So it's going to, I guess if you take oil out of the equation, it probably won't be so bad. But, I mean, this is the big week for technology. And I think you really could end up having two markets where if technology keeps rolling along, I thought Qs were the best buy last year, and mostly because they hold, Microsoft, Amazon, Facebook, Google, blah, 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 blah. I don't see a whole lot to make that different as far as outperformance goes versus the SPX until, oil turns around. I think you could probably scoop some financials because it looks like they're going to have to do something with rates. But other than that, I think the growth picture looks still kind of muted with all the overcapacity in commodities and things like that. So we need a reason to rally right now. Central bank easing, as much as they jawbone about it, looks pretty much off the table. They can't do anything else anymore. Considering what's really wrong is China's not growing really fast anymore and oil prices are going down. So there's not the kind of liquidity crises that the central bank should be stepping in for. They ought to just take whatever their toolbox is and just stuff it under the seat of their pickup truck and, drive on. So
that's quite the image. The Fed governors hopping in their pickup trucks. Because I did hear some Fed governor talking, I think it was last week, about how he doesn't have a Bloomberg terminal, doesn't pay attention to the vacillations of the marketplace. If you buy that, I think I have a bridge I want to sell you. But that said, they are trying to play up this narrative that this craziest January since 2009 doesn't play into their calculations at all. If it doesn't, then that's an issue in and of itself. But c'est la vie. I don't think anyone credible really gives them a lot of chance of raising this week. If they do, maybe we should talk about that on an upcoming show. If they do raise, what's going to happen to this already just sucker punched market? It's just going to fall off a cliff, but that's a conversation for another day. We have to wrap it up here. Listeners, devoted listeners, for thanks for sticking with us for this extra fun episode of the Option Block with all the fun technical issues going on. Some of them you couldn't even see behind the scenes, listeners. So it all irons out in the wash here, to mix my metaphors. But before we go, Mr. Rock Lobster, what's cooking in the land? Oh, the pit.
We're going to be having a beginning boot camp, like the 20th, 21st through the 24th at Option Pit. It'll be a 3-day boot camp, just beginning options. We've never done a really beginning class before. Mostly it might be because Mark's writing the book, and I guess we have to write a glossary about options or something. But it will be a beginner easy stuff, and hopefully, again, it will be priced very, very well. We had our best Saturday attendance ever last weekend, the Saturday class. So maybe our gospel of education before trading is finally spreading. So hopefully it is.
We shall see. Surf on over to optionpit.com to learn more. And he couldn't make it, but of course, I'll give him a plug anyway. Good old Uncle Mike. Search on over Amazon for Go Long. He was saying it's only $2.99 for the Kindle version. So by all means, I think you got $3 burning a hole in your pocket. You can skip the latte tomorrow and pick up Uncle Mike's book instead with updated new editions. Read it on your Kindle at your leisure and enjoy all that wisdom he likes to bestow here on this program, but in book form, so you can read along with it on the train when you're not listening to this fine program. On behalf of the Rock Lobster and Uncle Mike, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show, and of course, for sending in such great questions. Keep them coming, and we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.